Hi class, and welcome to this video on VCE Year 12 Economics, which covers Unit 4 Outcome 1 content. Here we're focusing on monetary policy, and this key knowledge point is going to this video is going to think about how has recent monetary policy impacted the aggregate demand and the Australian government's domestic macroeconomic goals. So we're going to cover what the goals are, what is the history of monetary policy, and try and find some links into how that has occurred. Now, if we're looking at our key knowledge from the study design for monetary policy, you can see that it is near the very end of monetary policy. So it has got some assumed knowledge that you have either understood the last 4 key knowledge points, and you might want to rewatch those videos if you're a bit unsure. And as I said, this video is going to focus on the history of monetary policy in Australia. Now, study design says that we only need to know for 2 years. We're going to go back a little bit further to give you the history, but the last 2 years is probably the most important for your study design. And we're going to think about how those monetary policy decisions, the rises and falls of interest rates, will have impacted aggregate demand and the goals of Australia. And the goals which we talk about all the time are strong and sustainable economic growth, so as high GDP as possible, full employment, which is as much employment as you can without inflationary pressures. When I say sustainable economic growth, I mean growth that isn't driving inflation as well, and hence low inflation as well. And that demonstrates the link of why monetary policy is all about controlling inflation, because we know inflation is inbuilt in our other goals as well. So what's happened? And remember, you only need to be an expert of the last 2 years, but if we see on my bottom left, you can see the Australian cash rate all the way back at 2017 was about 1.5%. And we can see that it's remained flat, then had some significant drops to get it to a very low 0.1%. And in recent times, you can see there's been a really abrupt increase. So let's try and understand why that's occurred. What has happened up until 2019? From August to 2016 to May 2019, the cash rate was steady at 1.5%. Now remember, 1.5%, even though it's dropped significantly since then, was still quite low. The RBA was still taking an expansionary approach. It was trying to stimulate the economy because there was relatively low growth in the economy in Australia and the world and low inflation. In 2017, there was evidence that a further loosening would be appropriate. There was thought that maybe around here it might start to go down a little bit even more. However, the RBA decided not to. And they were concerned at that stage, that might drive a property price boom. If you think about the transmission mechanism video, we know reducing interest rates will increase prices. And the RBA was a bit worried that there was going to be a boom in house prices because there'd been a significant increase, and this escalation would occur if interest rates decrease, and they didn't think that was a good thing for house prices to be going up so much. In 2018, there was actually a thought that maybe the interest rates would increase because there was improved economic conditions. And you can see in 2018, we had some pretty good GDP numbers of over 3%. However, this did not occur because suddenly there was a drought. High household debt levels meant that there was concern that interest rates would impact households. And given there wasn't much wage growth, mining boom was coming off, retail sectors were struggling, they kept it around 1.5. So that's the history of why it stayed at 1.5 for a number of years. In 2019, the RBA took a significant expansionary approach, and you can see that it started to go down. In 2019, due to really low economic growth, growth in unemployment, and low inflation below the range of 2.3%, and you can see the growth was pretty low, the RBA progressively loosened monetary policy and took an expansionary policy approach and cut it to 0.75%. And you can see here, it went down to 0.75%. Why did this occur? There was a falling house prices. So suddenly they were okay with reducing interest rates because house prices had fallen off. There wasn't as much a boom. Global trade tension meant there wasn't much growth in the global economy. Low wage growth, so this was a way to give people more real wages because they had less interest to pay. High wholesale debt, low confidence, and there was a bushfire disaster. So the economy wasn't going great. The RBA could see that the economy needed a kick. They were okay to do it because inflation was low, so they kept cutting the interest rates. And then came 2020, and significant things happened in the economy. Now, many of us forget before COVID, the Australian economy had a massive hit anyway. There were significant bushfires in the eastern states, which really were disasters for many parts of the states and the economy. And then, of course, COVID hit. This resulted in a recession. And you can see our GDP really took a hit then. And we know 2 negative quarters of GDP results in a recession. And this was the first time since 1991 we had one. We suddenly had a recession. COVID had a significant impact on our economy, significant impact on demand and supply. And the RBA took the dramatic approach to go to near record level low cash rates. And suddenly by the start of 2020, at the end of 2020, we suddenly had a cash rate of 0.01%, almost free money. And you can see the RBA's monetary policy here if you want to have a quick look at it. But it makes sense, really low growth, negative inflation. If we look at a chart in a second, of course, the RBA needs to try and support and expand the economy. Otherwise, there was going to be even a bigger disaster. So what has happened in late 2021, 2022? We've had a giant spike in interest rates. That is a big jump very quickly up to 1.35%. We have hopefully left COVID, although I know that COVID is still really impacting many parts of the community. But we started to experience really big inflation, 5.1% in March. We also had relatively high growth rates, but from a low base. But if we go back a second, I apologize, you can see our GDP numbers were pretty strong. So high inflation, high GDP growth, although from a low base, remember the economy had shrunk, we are suddenly in a situation where the RBA needs to take a significant contractionary approach. They have raised the cash rate to 1.35% by July. It is almost certain to keep rising at a relatively rapid rate because we're expecting inflation to even be higher in next quarters. There is some talk of even 7% inflation. The RBA needs to try and bring inflation within control, and they have risen interest rates to try and take demand out of the economy. Now that has hopefully given you some of the history, and particularly in the last 2 years, really low interest rates due to COVID, bushfires, suddenly a rapid increase due to inflation increasing. And hopefully you can start to see these in these charts, which I'm just going to flick through because we've seen and talked about them, but you might want to have a look at them in a little bit more detail. So pause the video if needed. So this one is the annual inflation rate. This one is also the annual inflation rate, but with the numbers, but sometimes it is easier to see a trend with a line graph. Here we have our GDP, and you can see that we had our recession here as we talked about. I'm not sure what's happening on my pen due to COVID, and higher growth after there. When I say higher growth but from a lower base, remember the economy shrunk quite significantly in that recession. Here is our GDP, and here what I am talking about, such a significant decrease in our gross domestic product. So even though there has been increases since, you can see that we haven't reached the 2018 peak. So those numbers of high growth rates are from that low pace as I discussed. And we can see the unemployment rate has really dropped off. This has been a good news story, although the peak, of course, real peak of COVID, but it's started to really reduce. And this means we're happy to try and contract the economy a little bit because we're potentially even below full employment at the moment. So this is where we can start to hopefully see some of those patterns. And I've talked through these charts in another video in the expansionary and contractionary monetary policy stance. So hopefully you've watched that video, but this is hopefully able to see the pattern where inflation is being driven. When inflation goes above that 3%, we will have when it goes above 3%, a contractionary approach, or restrictive as it's discussed here, because you can see the red line is above 3%. And you can see here, because inflation was so low during the time of 2017 to 2020, the RBA was happy to keep reducing interest rates. So to summarize and bring it back to our key goals, the expansionary stance of 2017 to 2021 impacted our goals. The expansionary stance, or loosening of monetary policy, increased aggregate demand, which was through the transmission mechanisms. These lower rates depreciated the currency, meant the prices of imported goods will rise, increasing the components of inflation. Inflation was theoretically rising, would rise because of these expansionary stances. Low inflation was seen as a precondition to try and drive economic growth and full employment. And you can have a read of this slide, which we've talked about. The contractionary stance since is all about reducing inflation. And I encourage you to pause and read this slide. And we know that this contractionary expansion will reduce GDP and the unemployment rate. But we know that the unemployment rate is at a historical low rate, around 4%, and economic growth is relatively high, as we said, from a reduced base post-COVID. So I've gone through this one relatively quickly. Feel free to pause the video, try and find those patterns and relationships in the slides. Have a read of the last two slides, which explain the impact on the goals due to the expansionary and now contractionary stances. But for now, I hope that this has been a good recap of the monetary policy of really the last 5 years, because we've gone all the way back to 2016 and 17. Understanding that the last 2 years is the bit that will be potentially assessed in your exam. And we've understood that the past 2 years is really interesting. It's had steep expansionary and then really big contractionary approaches, and understanding how those approaches impact economic growth, full employment, and inflation is going to be really important for your assessments. Hope this has been a useful video, and keep studying VCE Economics.